Beginning this week, we are going to do something a little bit different on Saturdays. We'll simply look back at the news from the last 7 days to catch everyone up on the week that was in Bitcoin News Digest. And it's been quite a ride, hasn't it? Bitcoin navigating some serious macroeconomic storms, while at the same time really building a foundation for something much bigger.
That's a perfect way to put it. Yeah, this past week really showcased a fascinating push and pull. On one hand, you had these immediate market pressures from global economic events, creating some real volatility. But then simultaneously, there was this profound strengthening of Bitcoin's underlying structure. Big steps in regulatory clarity, institutional adoption.
Yeah.
It's really a story of separating that short-term noise from the powerful long-term signal. And our mission today is just to help you unpack what that actually means for Bitcoin's path forward.
Okay, let's jump right into the immediate reality for many of you who track it daily. Bitcoin's price action this past week. It certainly felt like a bit of a roller coaster, didn't it?
It really did.
We saw Bitcoin hit that record weekly close near $119,450 on July 28th, which was, fantastic. But then it faced a pretty decisive rejection around the $120,000 mark.
That level proved tough.
And by August 1st, we were looking at about a 3% drop and its fourth consecutive day of losses. That was the longest streak since mid-June, actually. That trend continued right into August 2nd with a sharp correction down to $113,261.32, its lowest close since July 9th. So that made it 5 straight losing days. What was really driving this immediate downward pressure?
That's the key question, isn't it? And our sources really point clearly to these broad macroeconomic forces at play. We've seen a decidedly hawkish stance from the U.S. Federal Reserve this week.
Okay.
Now, that means they're prioritizing inflation control, often, through higher interest rates.
Okay.
At their July meeting, they kept the benchmark interest rate steady, between 4.25% and 4.50%.
What does that do, practically speaking?
Well, it generally strengthens the U.S. dollar. And when the dollar is strong, it tends to discourage what we call risk-taking in assets like Bitcoin.
Right, makes sense.
It just makes safer dollar-based investments look relatively more attractive, you see.
So a stronger dollar pushes against riskier assets. Was there anything else adding to that pressure?
Oh, absolutely. On top of that, new U.S. trade tariffs were announced. And that kind of thing often fosters a risk-off sentiment globally.
Okay, risk-off. What does that mean for markets?
It's basically when investors pull money from assets they see as more volatile, think stocks or crypto, and they move it into things they consider safer havens, like bonds or maybe even just cash. And then there was the U.S. July jobs report. It came in much weaker than expected. Non-farm payrolls only rose by 73,000.
Wow, that's low.
It is. And there were significant downward revisions for the previous months, too. A weak jobs report can signal an economic slowdown, which, again, just reinforces that risk-off attitude. So you put all that together, it puts direct downward pressure on Bitcoin. And it challenges that idea of it being a completely uncorrelated hedge against traditional markets.
How so?
Well, its 24-hour correlation with the S&P 500 actually surged to 0.86 by August 2nd. That's quite high. It shows Bitcoin, for now at least, is moving pretty much in lockstep with major stock markets.
So we're seeing Bitcoin behaving more like a traditional risk asset, at least for this period. Now, when prices drop like that, does it lead to what some people call cleansing events in the market, pushing out some of the speculation?
It absolutely does. And we saw that playing out very clearly this week. Those sharp declines led to really significant liquidations of leveraged trading positions.
Can you break down what liquidations means here?
Sure. So basically, when traders borrow money to amplify their bets, that's leverage, and the market moves sharply against them, their positions get automatically closed out by the exchange. They get liquidated. We saw over $1 billion liquidated by August 1st. Then another $630 million on August 2nd. And these were predominantly from bullish long positions people betting prices would go up. Yeah, it's painful short term, but it does act as a necessary market cleansing event. It kind of flushes out excessive speculation and maybe some unhealthy leverage. It often lays a healthier foundation for the next move up.
Okay. And despite all this downward pressure and the liquidations, were there any technical indicators or, market signals that offered maybe a different perspective, a silver lining perhaps?
There certainly were, actually. While some short-term metrics like the Relative Strength Index or RSI showed what's called negative divergence earlier in the week, hinting at potential weakness. The long-term technical outlook for Bitcoin, surprisingly, remains pretty positive for many analysts.
Really? Even with those drops?
Yeah, and what's truly fascinating here is that even with that price drop, 97% of Bitcoin's total supply remains in profit.
97%.
97. Think about that. Almost all Bitcoin holders are still in the green compared to when they bought it. That reflects a pretty profound underlying market strength, right? And conviction among those long-term holders.
That is remarkable.
And the derivatives market offered another, maybe, glimmer of hope. On August 1st, the put-call ratio was relatively low at 0.65.
Okay, put-call ratio. Remind us what that tells us.
Right, so it compares the number of put options, which are bets on the price going down, to call options, bets on the price going up. A lower ratio, like 0.65, means there are more calls than puts.
For more people betting on a rise.
In the derivatives market, yeah. It often signals a more optimistic sentiment among those traders, maybe positioning for a recovery. It suggests that while there was short-term pain, maybe some sophisticated players were still betting on an upward move relatively soon.
Okay, so we have the immediate market volatility, the macro pressures. But if we zoom out, like you said, the more profound story this week seems to be this acceleration of regulatory clarity and institutional integration, particularly in the U.S. This feels like that long-term signal you mentioned. What exactly happened on that front?
Yeah, this is really where the long-term narrative for Bitcoin just shines. And it could be a game changer. The White House Working Group on Digital Asset Markets, they released a roadmap this week. And it effectively calls for a golden age of crypto in the U.S.
A golden age? That sounds significant.
It is. It's not just talk. It looks like a strategic pivot. The roadmap focuses on key areas like stablecoin implementation, tax modernization, and importantly, reducing compliance burdens. This signals a clear shift away from what we've maybe seen in the past, regulation by enforcement, towards a more structured regulation by framework.
Okay, less enforcement, more framework. What's the practical difference for crypto projects?
Well, it fundamentally changes the playing field. Instead of waiting for enforcement actions to figure out the rules, a framework provides clarity upfront. It moves from being reactive, maybe punitive, to being proactive and guiding. It could potentially unleash a wave of innovation that might have been held back by uncertainty. It tells builders, here are the rules of the road, which is just invaluable for long-term planning and investment.
That sounds like a really complete shift in approach, moving from maybe chasing bad actors to actually building a clear road for innovation. And didn't we see a huge partnership emerge right in the middle of all this regulatory progress?
We absolutely did. And this one is genuinely significant. A truly pivotal partnership was announced on July 30th. It's between JPMorgan Chase, one of the largest banks in the world, and Coinbase, a leading crypto exchange.
JPMorgan and Coinbase. Wow, what does that entail?
Okay, get this. Starting in 2026, JPMorgan's 80 million plus customers will be able to link their bank accounts directly to their Coinbase wallets, securely via API.
80 million customers? Direct link.
But wait, there's more. Chase customers will also be able to convert their ultimate rewards points directly into USDC stablecoin at a $1-to-1 value. That also starts in 2026.
Points to stablecoins. That's fascinating.
And even sooner, this fall apparently, Chase credit cards will be enabled for direct funding of Coinbase accounts.
Okay, that is massive. What's the deeper implication here? I mean, beyond just convenience for customers.
It's a watershed moment, truly, because it normalizes access to crypto within existing trusted banking relationships. For years, many big banks looked at crypto with suspicion, maybe even hostility. This partnership, it signifies a fundamental recognition of crypto's permanence and its utility.
So it's like an endorsement.
Exactly. It's an endorsement by a mainstream financial giant that basically tells millions of ordinary customers, hey, this is legitimate and you can access it right here through the bank you already trust. It sets a powerful precedent for probably every other major financial institution to follow suit. And we're already seeing others, like PNC Bank, announce similar crypto-as-a-service offerings.
Right.
This isn't just about making crypto easier to buy. It's about weaving it into the very fabric of traditional finance, building those on-ramps and off-ramps right into your checking account, essentially.
So traditional finance isn't just looking anymore. They're actively building the bridges. But beyond individuals getting access, what about corporations themselves? Are we seeing companies continue to add Bitcoin directly to their balance sheets? Is that Bitcoin treasury strategy still gaining momentum?
It is, absolutely. And it's becoming a global thing now. The Bitcoin treasury strategy is definitely picking up pace. Strategy Inc., formerly MicroStrategy, they made headlines again this week. They raised a staggering $2.5 billion in a public offering.
$2.5 billion. For what?
Specifically to acquire more Bitcoin. Another 21,021 BTC. That brings their total holdings to an immense 628,791 BTC as of July 30th.
Unbelievable.
And get this, their Q2 2025 earnings reported record revenue driven almost entirely by, wait for it, $140 billion in unrealized gains from their digital asset holdings.
So Bitcoin is their strategy now.
Pretty much. It's a public company making Bitcoin accumulation its core business strategy. And it's not just them. Tokyo-listed Metaplanet, people often call them Asia's MicroStrategy, they acquired another 780 BTC this week. That brings their total up to over 17,000 BTC, worth roughly $2 billion.
That's a significant commitment from these companies. What does this broader trend, this corporate adoption, really signify?
It signals a pretty profound shift in corporate finance, I think. We're seeing a wider wave of companies like Sequence Communications, Capital B, 3E Network Technology Group making significant Bitcoin allocations to their treasuries. This is creating a new, consistent, and importantly, a relatively price-insensitive source of demand for Bitcoin.
Price-insensitive. How so?
Well, these aren't short-term speculative traders trying to time the market. These are corporate treasuries making strategic long-term decisions. They're holding Bitcoin as a primary reserve asset, planning to hold for years.
Right. Long-term conviction.
Exactly. It's a testament to that conviction, viewing Bitcoin not just as a gamble, but as a viable, potentially appreciating asset for a corporate balance sheet. Even Coinbase itself jumped back into the top 10 public company Bitcoin holders. They bought another 2,509 BTC in Q2, showing their own belief in the asset they handle. This trend is all about the institutionalization of Bitcoin, making it a potential staple, not just for individuals, but for major entities too.
Okay, so the U.S. is clearly moving towards regulatory clarity, institutional embrace. But what about the rest of the world? Is it a uniform move towards crypto everywhere, or are we seeing a more fragmented landscape?
Oh, it's far from uniform. It really highlights the global complexity of integrating something like Bitcoin. We're seeing a real patchwork of approaches. For instance, on August 1st, Indonesia actually implemented a more stringent tax regime for crypto transactions. They doubled the seller tax on domestic exchanges to 0.21%. And they increased the tax on foreign exchange trades fivefold, up to 1%.
Wow, that's going the other way. What's the likely effect?
Well, it could potentially stifle growth there. And maybe, paradoxically, push activity towards less regulated, maybe peer-to-peer channels.
A stark contrast, then. What about places where adoption seems to be flourishing?
Exactly. In stark contrast, you look at El Salvador. It continues to be this fascinating case study in grassroots Bitcoin adoption. We're seeing local initiative actively supporting small businesses, entrepreneurs, using Bitcoin and the Lightning Network for just everyday payments.
So real-world use cases.
Yeah, it really demonstrates Bitcoin's utility as a censorship-resistant medium of exchange, showing how it can actually function at a microeconomic level, empowering communities. Then you flip again. Earlier in the week, South Korea's Financial Supervisory Service informally warned their domestic asset management firms to reduce exposure to crypto-related stocks, basically upholding a 2017 ban on direct crypto investment by institutions.
So very different approaches indeed.
It really highlights this fragmented global regulatory landscape. Some nations embracing it, others tightening controls, and some still remaining cautiously prohibitive, despite the global trends.
Interesting. Let's bring it back to the core technology, Bitcoin itself. Were there any significant developments or maybe internal debates within the network this week we should know about?
I think I heard something about a debate regarding a proposed change for the Bitcoin Core 30 update, something about op return.
Yes, that's a fascinating internal debate, actually. And it really gets to the heart of Bitcoin's decentralized governance. There's a proposal on the table to significantly increase the data limit for something called the op return function.
Okay, op return. What is that, simply?
It's basically a small space on the Bitcoin blockchain where users can embed tiny pieces of data, non-financial data. This function became really instrumental in the rise of Bitcoin ordinals. You know, those unique digital artifacts, kind of like NFTs, inscribed directly onto individual Satoshis, the smallest units of Bitcoin.
Right, ordinals. So what's the proposal?
The proposal is to make that data space much larger. Proponents argue this expands Bitcoin's utility beyond just financial transactions. It opens up new possibilities for innovation, for data storage, all on the most secure blockchain network. So they see it as expanding what Bitcoin can do, making it more versatile. But I gather there's another side to that argument.
Absolutely. There are opponents whom, some sources call Bitcoin purists, maybe. They view storing non-financial data, like ordinals, essentially as spam.
Spam? Why?
They argue it clogs the network, increases the size of the blockchain over time, which makes it harder for people to run nodes, and ultimately it raises transaction costs for everyone. They feel it makes Bitcoin less efficient for its primary purpose, peer-to-peer digital cash.
So a real philosophical debate within the community.
Exactly. And this internal struggle has even led to a measurable drop in Bitcoin Core's dominance of network nodes. Some users are switching to alternative client software that might align better with their view on this. It perfectly demonstrates Bitcoin's decentralized governance in action, though. There's no single boss making decisions. It's a constant, sometimes messy dialogue among users and developers. That's both the beauty and the challenge of a truly decentralized system.
Indeed, that decentralized nature is key. Okay, beyond these internal network debates, are we seeing Bitcoin's utility expand in more real-world applications, particularly for payments?
Yes, emphatically. PayPal, the global payments giant, made a really significant move this week. They launched Pay with Crypto.
Pay with crypto, what does that allow?
It allows U.S. merchants to accept payments in over 100 cryptocurrencies, including Bitcoin. But here's the clever part for the merchant. The system instantly converts the crypto payment into a stable currency for them, like fiat US dollars or even PayPal's own PYUSD stablecoin.
So the merchant doesn't face the volatility risk?
Precisely. It completely abstracts away that volatility risk for the business, making it a frictionless experience for them to accept crypto. This is huge because it fundamentally shifts Bitcoin's narrative, not just store of value, but potentially a functional global payment rail for everyday transactions. It opens up millions of merchants to crypto payments seamlessly.
That's a huge step for mainstream adoption, making it easy for businesses.
Yeah.
What about the more innovative, decentralized side of things? Are we seeing growth there too?
Oh yeah. On that front, we're seeing the BTC-Fi ecosystem, that's Bitcoin-based decentralized finance, experiencing just explosive growth.
BTCI, Bitcoin DeFi.
Exactly. This segment has surged from just about $300 million to over $7 billion in total value locked this year alone. $7 billion.
That's incredible growth. What does it signify?
It demonstrates that developers are increasingly building complex financial applications, things like lending, borrowing, trading, yield generation. But they're building them using Bitcoin's security and liquidity as the base layer. Often this happens through Layer 2 solutions.
Layer 2s, right. Those are built on top of Bitcoin.
Yeah, essentially separate networks built on top of Bitcoin that handle transactions off the main chain, making them faster and cheaper. For example, Bitcoin Hyper, which is Layer 2, just raised $5 million. Their goal: to build Solana speed decentralized applications directly on Bitcoin. It truly signals Bitcoin's evolution beyond just being digital gold. It showcases its potential as a foundational layer for a whole, vibrant, decentralized financial system.
So as we wrap up the week that was, it really sounds like Bitcoin is at this fascinating crossroads. You've got the short-term volatility, the macro headwinds, but then these incredibly powerful long-term trends playing out underneath, laying a foundation for something entirely new. What's the main takeaway you want listeners to walk away with from this week's news?
I think the core message for you to consider is this. While Bitcoin's short-term price action, it remains influenced by those traditional macroeconomic fears, and also by the necessary cleansing of speculative leverage. The long-term picture for Bitcoin is profoundly strengthening. The market's foundation has actually proven surprisingly resilient. It absorbed significant sell-offs this week with a remarkable degree of stability, all things considered. On-chain data consistently indicates a clear trend: strategic, long-term accumulation by holders. That suggests deep conviction. And maybe most importantly, the regulatory landscape in the United States is undergoing this significant, coordinated, and frankly positive transformation. It's aiming to foster innovation, provide that much-needed clarity. And that is systematically removing a major obstacle for large institutional capital, allowing it to flow in with much greater confidence. The bedrock for Bitcoin's future as a global financial asset, it really appears to be solidifying, even while the daily news throws up these temporary challenges.
Okay. So for those of you trying to make sense of the daily headlines, trying to distinguish between that noise and the signal, what should you keep an eye on moving forward? What are the key things to watch?
Well, definitely continue to monitor Bitcoin's ability to defend those critical technical support zones, particularly around the, say, $110,000 to $112,000 mark. These levels tend to indicate underlying buyer demand.
So watch the price levels. What else?
Beyond price, watch the speed and the clarity of new regulatory implementations coming out of U.S. agencies. Consistent progress there will likely be a powerful catalyst. And keep an eye out for more bank crypto partnerships that replicate that JPMorgan Coinbase blueprint. That's a key indicator of mainstream financial integration picking up steam. And finally, pay close attention to the Federal Reserve's rhetoric. Any shift towards a more dovish stance, meaning a less aggressive approach to interest rates, could provide a significant tailwind for all risk assets, and that includes Bitcoin. The challenge really for all of us lies in distinguishing that short-term noise, the macro-driven volatility, from the powerful long-term signal of a maturing market and a fundamentally de-risked regulatory environment in key jurisdictions.
This week has truly shown us the dual nature of Bitcoin in the current global economic climate. As Bitcoin increasingly integrates into the global financial system, it does raise a fascinating question. How will its dual nature acting, sometimes like a risk asset, sensitive to macro trends, and other times like a potential safe haven, resilient in its core structure, how will that evolve in future economic shifts? That's certainly something to think about. And that's it for this edition of The Week That Was. Join us next time for another deep dive into the stories shaping our world.